Hello and welcome. Today, we're going to dive into one of the most powerful and, frankly, least understood forces in all of economic history, the long-term debt cycle. This is a pattern that you see repeat itself across centuries, across different civilizations, and it's what drives the booms, the busts, and even the rise and fall of empires. Really understanding its mechanics is, I think, essential for navigating our financial future.
You know, this statement from our source material really sets the stage for our entire discussion. It frames these massive crises not as some kind of rare, unpredictable accident, but as a recurring and, believe it or not, predictable feature of economic systems. The cycle is driven by something very fundamental, the mechanics of credit and, well, human nature itself. So here's our game plan for this explainer. We'll start with the basic logic of the cycle. Then we'll dissect its anatomy, going stage by stage. We're going to pay very close attention to that critical deleveraging phase and see how monetary policy has to adapt. And then, most importantly, we'll wrap it all up with what this means for you as an investor.
All right, let's jump right into our first section. Here, we're going to establish the foundational concept of credit and really examine how the very natural incentive to use it ends up creating these incredibly powerful, long-term economic cycles. At its absolute core, the entire system is built on this one simple trade-off. Think of credit as a stimulant. It allows us to pull future spending into today, and that creates booms. But the repayment of that credit, the debt, it acts as a depressant because it forces us to push today's spending off into the future. It's this oscillation, this back and forth, that is the engine of all debt cycles.
Now, what's really important to understand is the distinction between two different types of cycles. We're all pretty familiar with the short-term business cycle, right? The one that lasts a handful of years and is managed by central banks raising and lowering interest rates. But here's the key. These short-term cycles build on top of each other. With each little boom and bust, the total amount of debt in the system tends to ratchet just a little bit higher, and this accumulates over decades until the entire system reaches a breaking point. It's this long-term cycle that we're focused on today.
Okay, so let's move on and break down exactly how this multi-decade story unfolds. We can actually map out the progression of the long-term cycle into 5 very distinct and sequential stages. And if you can recognize the characteristics of each stage, you can get a much better sense of where we are in the broader cycle.
These 5 stages, they really tell a complete story, a full narrative arc. It all begins with prudent, sound finance, which then progresses into a speculative bubble. It eventually reaches a peak, then has to endure a painful but completely necessary deleveraging, and finally it establishes a new, lower debt equilibrium from which the next cycle can begin all over again.
You see, every cycle starts out in a really healthy place. In what we call the sound money stage, debt is low and it's used for productive investments, things that generate more than enough income to pay the debt back. But this success breeds confidence, and that confidence can slowly morph into overconfidence. And that's when you enter the debt bubble stage. This is where the dynamic flips. Debt starts growing way faster than the income needed to support it, and it fuels speculation, pushing asset prices to levels that become completely disconnected from reality. And make no mistake, the top of the cycle isn't some random event. It's a purely mechanical outcome. Eventually, the system just cannot support the ever-accelerating rate of new debt that's required to keep pushing asset prices higher. At that point, either lenders get nervous and pull back, or the central bank is forced to tighten credit to fight inflation. When that happens, the flow of credit reverses, and pop, the bubble is over. And this brings us to what is, without a doubt, the most critical and turbulent phase of the entire cycle. The debts that have been accumulated over decades have simply become too large to be serviced, and the system now has to go through a painful reckoning. This is the deleveraging. So how does it all start to unravel? Well, it often begins with a simple loss of confidence. Creditors, the people and institutions who hold debt assets like bonds, they start to worry. They fear they won't be paid back with money that holds any real purchasing power, and so they start to sell those assets to get their cash out. Now, this initial selling, it creates a classic supply and demand problem. To attract new buyers for all the bonds that are being sold, the interest rate on that debt has to go up. A higher yield is needed to compensate new investors for what they now see as a much higher risk. And this is where you can really see the self-reinforcing nature of a crisis kick in. The higher interest rates, which were a consequence of the initial selling, now make the overall debt burden in the whole country even more unsustainable. This just confirms the fears of the original sellers, which prompts even more selling, forcing rates higher still.
This dangerous feedback loop is what's known as the debt-death spiral.
This spiral forces policymakers into a terrible corner. They face an impossible choice. Option 1. Allow the death spiral to continue, which would lead to mass defaults, bank failures, and a devastating deflationary depression. Option 2. Intervene by, printing money to buy the debt that nobody else wants, which inevitably devalues the currency for everyone.
You know, when you look back through history, the answer here is crystal clear. While printing money is politically painful, the consequences of a full-blown deflationary depression are considered absolutely catastrophic and socially destabilizing. So for any country that controls its own currency, the choice is always, eventually, to create the money and devalue.
So to manage this deleveraging, policymakers have basically 4 levers they can pull. The first one is austerity, or spending less. That's often the first instinct, but it can be really counterproductive. Because remember, one person's spending is another person's income. Widespread cuts can actually shrink the economy faster than they shrink the debt. So that leaves the 3 more powerful levers: outright debt defaults and restructuring, the printing of new money or debt monetization, and finally, wealth transfers through higher taxes. In the end, it's always some combination of these that resolves the crisis.
Now, the ultimate goal for policymakers is to achieve something the source material calls a beautiful deleveraging. This isn't a painless process, not at all, but it is a balanced one. The deflationary pressure from writing down some of the debts is carefully offset by the inflationary stimulus from printing money. The whole point is to get nominal economic growth to run just a little bit higher than nominal interest rates, which allows the economy to gradually, over time, grow its way out from under the crushing debt burden.
You know, all of this pressure from the long-term debt cycle naturally leads us to our 4th section. It forces central banks to constantly innovate. The actual tools they use, the very nature of monetary policy, has to evolve as the old methods just stop working against ever-rising debt levels.
This timeline tells an absolutely critical story of adaptation. We started with what you could call monetary policy 0, a hard money system like the gold standard, where policy was rigid. That gave way to monetary policy 1, the era we're all familiar with, managing the economy by adjusting interest rates. But when rates hit 0 in the 2008 crisis, that main tool was exhausted. That forced the shift to monetary policy 2, better known as quantitative easing, where central banks started printing money to buy financial assets. Then the crisis of 2020 pushed us even further into MP3, where monetary and fiscal policy basically merged to directly finance massive government spending. Each step represents a more powerful, more direct, and frankly, more desperate intervention that was born out of necessity.
Okay, we've covered a lot of ground, but this brings us to our final, and for you as an investor, arguably the most important section. What does the end of a long-term debt cycle actually mean for someone trying to manage their capital?
The whole reason we invest, right? It's to find a reliable storehold of wealth, an asset that will at least maintain and hopefully increase its purchasing power over time. The key risk at the end of a massive debt cycle is not necessarily an explicit default, but rather that the money you get paid back with buys significantly less than the money you originally invested.
And this is where the distinction becomes absolutely fundamental. Bonds are, at their heart, a promise to deliver a certain amount of currency to you in the future. But during a deleveraging, when central banks are forced to print, the value of that currency is precisely what is being diluted. In contrast, productive assets like equities, which represent a claim on real economic earnings, or alternative stores of value like gold, they tend to preserve their real value much more effectively in the face of a devaluing currency.
And if you think this is all just theory, well, let's look at a very real-world example, Japan. This is not a theoretical exercise. Since 2013, as Japan is engaged in massive debt monetization, an investor holding Japanese government bonds has suffered a catastrophic loss of real global purchasing power. Measured against the US dollar, that loss is 45%. Measured against gold, it's a staggering 60%. Now, these bonds never officially defaulted, but their primary function as a storehold of wealth completely and utterly failed.
So we'll end with this question, which really gets to the heart of the challenge for any investor today. It forces us to look beyond just nominal safety and credit ratings and to ask a much more fundamental question about the future purchasing power of the assets we hold, especially those assets that are simply a promise to deliver a currency in a world that is already awash in debt.
All right, that's it for this deep dive. Thanks for joining us here at FinBot Insights. If you found this explainer on the long-term debt cycle valuable, please click like and subscribe for more analyses on the major forces shaping our financial world.